All right, let's go ahead and throw up the chat there. I see some people were already commenting before we even went live. Sorry for the little delay there, but welcome everyone. Good morning. If you just now tuned in, feel free to drop a chat there or a comment there in the chat, I guess I should say. Good morning to everyone. We'll just wait just a couple of minutes here, give everybody a chance to jump on and also go live on all the different platforms. This is streaming on YouTube, LinkedIn, Facebook, and Instagram. So let us get all the streams up here and then we will get started. But thank you everybody for tuning in nice and early. Hope everyone's having a great Friday. And we'll get into it here shortly. Hello, Adam. Both Adams. Ashley, good morning. Good morning, everybody checking in. If you're just now jumping on, we're just waiting a minute here to get started, go live on all the different platforms. But feel free to drop a comment in there when you come on. Okay. It looks like we are good to go. We can go ahead and get started. All right. Welcome, everyone. My name is Kyle Hiersche. I am the COO of the Mortgage Calculator, here joined with our president, Nick Hiersche, and our sales manager, Jose Gonzalez. What we do every morning here at the Mortgage Calculator is go through the different rates for all the different programs, the live actual rates, so we can see what the rates look like from day to day. So obviously we went through this yesterday. I have a feeling there's going to be a large change in rates today because of the different things going on out there and the different news coming out. So it'll be fun to see how the rates move up and down. Every day we also do a deep dive into a topic, and today we're going to do a deep dive into HELOC Combo Loans. I'll have Jose talk a little bit more about those and how we can use those to solve a lot of different problems here as a loan officer or a client looking to get a tricky loan done. So what we'll do first is we'll have Nick go ahead and pull up the pricer and go through our different actual pricing for today so you can see what it looks like. Then we'll have Jose go into a deep dive. So go ahead there, Nick. Go ahead and take it away.
All right, thank you, sir. Let me go ahead and pull up our pricing tool and switch my screens real quick, and we'll get started. All right. So this is our pricing tool for our mortgage professionals. We have over 300 licensed loan officers in all around in pretty much every state. We are licensed in 22 different states for primary and second home loans, and we can do our DSCR business purpose and commercial loans in pretty much every state. So if you'd like a full loan estimate, please get with our team. This is our pricing tool that's just going to show the rates and pricing indications for our general programs today. It is March 10th, just after 11 a.m. Eastern, so all of our basic programs are live. So we will go through our pricer today to check out the general pricing on our programs. So what we're going to do is we're going to set up a basic scenario and then go through the different loan types. So our scenario here that we're going to set up, we'll set up a $400,000 nice easy loan amount, set up an 80 LTV, 80% loan, 20% down payment. We're going to search for a desired price of 99. That means we're going to find the best rate at a one discount point in cost. Most of our customers are asking to buy down the rate a little bit. So this is the most common scenario in this higher rate environment. We're going to go through a few demos today. We'll do our conforming conventional first. Then we'll go to our FHA loan programs. And then we'll pull up our expanded guidelines, aka non-QM. We have over 4,500 loan programs under non-QM. That's where we can do our alternative income documentation and all of the cool stuff we love to do. So we'll go through those. VA is for our eligible veterans, so we appreciate all of our vets out there. If you need a quote, please get with us. But since not everybody's an eligible veteran, we won't do that live today. If you need a quote, we'll do that very quickly for you, though, no problem. And same with USDA. Property must be in a USDA eligible rural area. So if you are looking for that, please let us know. We'll be happy to quote it. But since not everybody is, we won't do it live every morning. So let's start with our conforming conventional. We'll continue to set up our general scenario. It's always going to be a purchase, a fixed rate 30-year term, pretty standard loan, primary occupancy for our first three examples here, single family, nice and easy, 1 unit, state of Florida, county Miami-Dade, that's where our office is based. And we'll use an estimated FICO score of 760 for all our examples and an estimated debt to income ratio of 40% for all of our examples here. So let's go ahead and click show rates and see what we have today. Let me get through my security check. Guess I got that first one wrong. And awesome! Finally, some positive news, guys, right? So the rates have dropped today. Had a lot of economic news going on, a lot of volatility. So unfortunately, the last couple of days they were up a little bit. Today they're down a little bit. So we love to see some downward motion. So 6.75 rate for 1 discount point in cost. Remember earlier this week we were over 7. And last week we were a little lower, right? So we love to do this show and watch as the real rates for our real programs every morning come out so we can see exactly what all this economic news means for you, the borrower, or if you're one of our team members, obviously, you want to watch this as well. So we love to watch these things. Now, pay attention here to the APR. Remember, 6.75 rate, 1 discount point in cost. That has an APR of 6.926, which includes all of the fees and allows us to compare apples to apples. So as we switch through our other options, make sure you compare APR. Will give us a nice way to compare. So if a customer for any reason doesn't qualify for a conforming conventional loan, the next option we typically go with is an FHA. So let's set up the same scenario. We'll click on FHA options. Everything else will stay the same as it was before. And let's compare our FHA to our conventional. So same thing here. The FHA is a little bit down. I believe yesterday was 6.125 on our example here. And notice this one's a little higher. So this would be the example I would give to my customer, obviously. 6% rate for 0.75 discount points and costs. And here's the key, guys, 6.593 APR. So you can compare apples to apples. Remember, FHA especially has upfront mortgage insurance and annual mortgage insurance that we pay monthly. So the APR is definitely something you should always be concerned about on FHA. But thankfully, last month, the government actually announced a reduction. So that's why you see these are much lower than they would have been just last month. So we love to do this show, and we love to see when new announcement goes in our borrowers' favor, right? Saves our borrowers money. So these are some amazing programs. You can see we even have some specialty stuff as well. If you need one of those specialty FHA programs, get with us. We'll be happy to quote it. Now, for our third option here. Let's pull up the same scenario, but now if a customer for any reason can't qualify for conventional conforming or even FHA, remember FHA has expanded guidelines, a little bit more leeway on the credit stuff and a lot more leeway on the debt to income ratios we can use with FHA. However, sometimes a borrower may still not qualify using those expanded guidelines. Therefore, we have a whole category called expanded guidelines, aka non-QM loans, where most other banks and lenders don't have these options, but we here at the Mortgage Calculator have over 4,500 loan programs under this button here when we click this option. So expanded guidelines allows us to do all kinds of different programs and most importantly, use alternative income documentation. So we'll go through an example here. We'll keep everything else the same, but you notice the new option that pops up when we go with non-QM, we have our income verification tab that pops up. So let me scroll down so it goes down. So we have full doc. That's what we do when we're doing conforming or FHA, right? 2-year tax return, full doc. That's what everybody's used to. So typically we wouldn't choose non-QM to go full doc, although that's an option. But we would typically use it to go alt doc, right? We have 1-year alt doc programs, 2-year alt doc programs, which are kind of the general ones. We have the asset related programs, which are very specific. We did a show on those last week. Please check that out. We have business bank statement programs for our self-employed entrepreneurs that use their business bank statements. We can use those, 12 and 24, very popular. And for our investment properties, the DSCR, we'll go over that in a minute. But our most common option for non-QM for a primary home is going to be our personal bank statement 12-month program. So that's what we'll do today. And that's going to be for our self-employed borrowers. Many times our self-employed borrowers, when they use 2 years of tax returns, often have write-offs and other things going on their tax returns, so they can't quite qualify maybe at all, or don't qualify for as much home as they want to purchase, even though they're making great money. So therefore, we're going to use 12 bank statements to apply a ratio and determine their debt to income ratio off of those bank statements, off of their actual cash situation, rather than their 2 years of tax returns. So most times our borrowers, especially our self-employed borrowers, can qualify for much more home under these programs. So not only is this a solution for borrowers who would not qualify at all, but also to get borrowers more home for their money, especially those that are self-employed. So let's check out our options here under our bank statement programs. So you'll see here, obviously non-QM is always going to be a little bit higher rate, because remember, these are programs that are alternative programs that otherwise our borrower would not qualify for. But we love to see when these are very comparable. Notice we have a 7.5% rate here for 0.75 in discount points. And to compare apples to apples, our APR is 7.539. So it's just about 1 point higher than the FHA was, and a little less than 1 point higher than the conventional was. So we love when these are all great options. We love to quote all our borrowers the different options that are available to them. And we love when the non-QM is very viable as a comparable option when we're comparing side by side. So we love to go through these. There's dozens of programs, as you see here. Obviously, there's some that go higher in rates. Some of these may allow things like a credit event, like a foreclosure, things like that. So please get with our team. There's all kinds of different flavors of this program. And that one's a little bit about the same, though. So please get with us. We'd be happy to quote these. There's all kinds of different options here for different types of loans that we need. But the most important thing is we're going to use those bank statements for the income. Now, let's go through our last couple examples for the live rates. Before we go into Jose's deep dive, we always want to do our investment property options. So we're going to do our last two examples for investment property purchases. We love to work with first-time investors, whether it's your first rental property or you have a portfolio of hundreds of properties. We'd love to provide options for you. So let's check out basic scenario. Same thing, 80% loan to value, 20% down payment, same loan amount we had before. And we're going to compare our conforming conventional loan programs for investment properties to our non-QM expanded guideline programs for investment properties. Remember, FHA, VA, USDA are not eligible for investments. So we'll quickly pull up our conforming conventional. Everything else is going to stay the same as all our other examples. And let's see what we have today. As I say every morning, unfortunately, there are no combinations under conventional for investment properties with one discount point in cost. So the best combo the computer found was a 7% rate, but for 3.375 in discount points in cost. Still decent APR, right? 7.255. So always look into that APR category there. But many times our investors want to save cash out of pocket, right? These discount points definitely could be used to purchase other investment properties or maybe improve investment properties investor already has. So many times our investors want other options. So unfortunately, conventional programs have added these loan level price adjustments to these investment properties. So we can't find that combo here, even if the investor wants to go up in rate. So we'll cruise down this list. You'll see there'll probably be a couple higher rate options for a little bit lower right here. Great. 7.49 rate for 2.5, 2.5 discount points, right? Still a great option for us for investors that want to save a little bit more money out of pocket, but unfortunately no 1% discount point options. So that's why we always want to give our investors two options to choose from. Whether if they qualify for conforming conventional, great. We would love to quote that for you. But what really gets us excited here is when we're able to add some non-QM expanded guidelines options for our investors. And that is because we have some amazing options. Most importantly, our most popular income verification option for investment properties is going to be our investor DSCR. And that's because there is no income verification required, no employment required for the borrower, no income verification for the borrower. We're simply going to use the estimated rental income from the property we're purchasing to determine if that rental income will cover the expenses, the PITIA for that loan. If that covers the expenses, that's a ratio greater than 1. And we have a ton of programs you'll see here in a second for anything with a ratio greater than 1. There's also different types of these DSCR programs we can use for ratios less than 1. So if the property doesn't quite cash flow, we still have options down to a 0.75 ratio and even some with no ratio required at all. So tons of options under these DSCR programs. Now, under non-QM investment properties, we always typically have a prepayment penalty. There's going to be options for zero. If we choose this, we'll have limited amount of loan programs. So that's always an option, but we typically don't choose that for examples because it's going to limit the programs. We're typically going to choose 3 years. That's the most common option. That'll give us the most programs and save us a little bit of money compared to zero. And there's a 5-year option, but that will limit the programs and save us a little bit of money. So the most common, 3 years, that's what we'll always use for our example here. And let's go ahead and check out our DSCR rates this morning. All right, looks a little better than yesterday. Again, we love to see downward action, right? We love to save you guys money, the borrowers out here watching. So this option yesterday was 8.99. Today, this morning, 8.75 for 0.85 discount point cost for an APR of 8.792. So obviously these non-QM DSCR loans are going to be a little bit higher rate, but most importantly, it's going to save our investors cash out of pocket. 0.85 discount points compared to over 3 discount points under conventional. So many times if the property cash flows, our investors are happy to take a higher rate here in order to save cash out of pocket. And of course, DSCR comes with a ton of benefits with no employment income verification, no income verification at all. And our investors that own, say, multiple properties can cash out multiple properties and purchase multiple properties at the same time and have multiple loans going at once, because each loan for a DSCR only requires us to look at that one property. We don't have to look at a bunch of income and employment and all this other stuff. So we have a ton of these options. Please get with our team if you want to get one of these quotes. There are different options for different DSCR values you see here, different options for different prepayment penalty amounts here, and obviously a ton of different rate and program options. Some of these may allow short-term rental income and other things, which is why they might be a higher rate. But please get with us. We would love to quote these options for you. So that is our live rates for today. Now let's go into our detailed example here with Jose, our sales manager. Let me just introduce the topic for those of you that have just joined us. So I'm about to pass it over to Jose Gonzalez, our sales manager, 27 years of experience as a realtor and a loan officer. So he has a ton of perspective, especially on this specific product. This is a specialty product that takes some knowledge to execute, and Jose's executed hundreds of these transactions. It's definitely something that we specialize in. So a HELOC combo, often misconstrued. So let's go ahead and set them straight, Jose, on how this works and what we use this specific tool for. And before you do, it's not non-QM, right? This is still going to be typically a conventional loan with a HELOC comboed onto it. So not necessarily non-QM for those of you that were tuning in earlier. So go ahead and take it away, Jose.
Awesome. Good morning, everybody. Thank you for joining us for Daily Mortgage Rates Live with the Mortgage Calculator. Yes, with my being in Florida, and you know how it is, Florida with condos, definitely the HELOC combo is something very dear to my heart. Those of you outside of Florida may not know what I'm talking about, but in Florida, there's an issue usually with condos collecting enough reserves to meet the Fannie Mae guidelines to be approved. So one of the workarounds we use is this, which I will get into more detail when I cover that loan. So this is something that we really employed originally when we were not the mortgage calculator lender yet, and we had less options. We definitely love to use this HELOC combo to have more options for the borrowers, either for a refi or for a purchase, because there's a lot of things that we can do with combining a HELOC with a conventional or even with an FHA first mortgage, but it's usually more combined with a conventional when we're trying to circumvent mortgage insurance needs, right? On any conventional loan, 80.01% and above usually means that you have to add mortgage insurance to the loan. No way to get around that usually on a conventional loan above 80.01%. So Fannie and Freddie do allow adding a HELOC combo And we like doing that up to a 95% LTV, either for a purchase or for a refi, which I'm going to show you now. So in the first example that I have here, it's a 95% combo purchase, right? Where we're going, you can either go 75% on the first, or you can go 80% LTV on the first. So here in this example now, what we're doing is twofold here. Now, we're not just circumventing MI, and let me first go down here so I can show you there's a HELOC there of $153,750. And there's a first mortgage here of $725,000. And there's a purchase price of $925. So normally in a scenario like this, where you have a purchase price, let's say above, for my scenario here, I'm going to talk about South Florida, where we have a maximum conforming loan limit of $726,200, I believe is our conforming loan limit. So normally, if we want to do this $925,000 purchase, the down payment is the difference between 925 and 725, right? That's 200. Well, in this case, actually, is what we're talking about. But if our borrower wants to do less than that, less than $200,000 down payment, what does he do? He uses a HELOC. He comes in with 5% down payment, which is the first loan that you see there with lowest cost option of 7% and the lowest rate option of 6%. And then you combine that with your HELOC of $153,750. Mind you, the rate's a little high, 13.75%, but this is 95% CLTV purchase. And keep in mind that the prime rate is at 7.75. So, there's what 5-6% margin there. It's not so bad on that, because you're coming in with 5%. Again, normally you'd have to be coming in with $200,000 down payment to do this deal, as opposed to roughly $46,000, $46,250 in our example here, more or less, to do this deal with 5% down. So essentially, you're talking about a jumbo buster, let's call this, right? Where we're coming in not having to get the jumbo loan, which could present additional difficulties because most jumbo loans, as far as I know, are max 90% LTV. Very few options there that are above a 90% LTV. You have like the doctor loans that are out there that have exceptions that will go to a higher loan to value in this scenario. But, other than those special situation doctor loans, this is really the only way to get above a 90% LTV when you're in the jumbo stratosphere, right? So 95% CLTV, jumbo buster right here. And, you can do that HELOC typically at least 250. We'd have to look at the guidelines to see how much higher they let us go than 250 when it's a combo purchase. But even if it's 250, you're looking at here being able to go up almost $1.1 million purchase and still be able to get that conforming loan. Keeping in mind that the benefits of the HELOC, like I mentioned here in my notes, the real benefit to the HELOC, besides all these other benefits, is that the borrower can engage an accelerated payment plan where they make a payment every 2 weeks of half the amount. And in essence, you're paying sooner, you're avoiding paying a lot of extra interest, all of what the interest compounding can do to you, and you will pay that loan off quicker, even if it is a little bit of a higher rate, because in the HELOC, you only pay interest on what you owe. So as you bring that balance down, you will be bringing down your payment, especially if you do this accelerated payment which is what they really recommend when you have a HELOC, as opposed to what most people do is they may choose to just pay the minimum payment, service the HELOC, and then all of a sudden, if they have it in 10 years and it becomes a fully amortizing 20-year loan, then they have to refinance out of it. So those are some of the pointers we want to make sure that our customers are clear. So this is our 95% option. We do have a 90% option. Same process. You'll note then that the rate is substantially lower on the HELOC because we're taking it up to a 90% CLTV instead of a 95. So you do have a much lower rate there, much lower payment also. And then the rate on the first is a little bit better as well. I'll slip on over to the first one here. Slightly better cost, 6.125 here is costing 16,313, and let's see what 6.25 is. 6.25, 12,688. Here's 6.25, 13,594. So it's actually a little bit more expensive there. So now we're going to go to our 95% refinance HELOC combo. Now notice I'm going to be showing you here basically 4 different uses for this HELOC, because now we're using it for a refi. But what makes this use special is that the first mortgage is set up as a rate and term refi, not as a cash out. So this would be the solution to your borrower saying, I'm not sure if I want to do the cash out. And mind you, there's another issue with the cash out besides being the higher rate. The cash out is going to limit the LTV and the CLTV to 80%. So you would not be able to do a cash out on the first and do the same HELOC combo, because the restriction would be 80% LTV and 80% CLTV when there's a cash out. But when there's a rate and term, then the CLTV is going to be the same as when it's a purchase. So what that does is it allows a borrower to capture a good rate, the rate and term rate on the first, and still have the flexibility of having the HELOC. Why is that good? Well, on the HELOC, even if they get the HELOC for the full amount, and in this case, our HELOC is $153,750, you are not required to draw the full amount of the HELOC. There is a minimum draw amount. I believe it's $50,000 would have to be drawn at closing, but they don't have to draw the complete amount. So they're not going to be paying that full interest payment from the beginning. Again, they're only going to pay on what they owe. So this allows a borrower the flexibility of being able to get that rate and term from us, and at the same time, simultaneously, without having to go to any additional outlet for their money, they can get that HELOC from us as well. We can use the same appraisal. Usually we don't have to do any additional title work. So it does streamline the process for the borrower, as opposed to they're getting a rate and term from us and then having to go to somebody else to do a totally separate process to get the HELOC. So they can combine these two loans in one shot and have a much more convenient and streamlined operation and get the 95% LTV. But wait, there's more. Just when you thought there were no more uses for the HELOC, this is probably our favorite use here in Florida for the HELOC, right? The 90% CLTV limited review condo purchase. Now, in Florida, like I mentioned at the beginning of the show, we have issues with condo associations collecting the required 10% of the annual budget that is required in order to be Fannie or Freddie Mac approved, right? In order for the borrowers to be able to do a 5% or 10%, anything less than 25% down payment for a combo. Because if you do less than 25%, and this is for Florida, I believe the rest of the US is 90%. So in Florida, if you do less, if your down payment is less than 25%, then the condo has to go through a full review process, full questionnaire, a couple of pages where they question everything, including the budget, delinquencies, percentage of renters to owners, which are three of the more difficult issues that they have to deal with. If we go 75% or less LTV on the first, obviously, then we have a limited review process, which does not require review of the budget, does not ask for delinquencies in the collection of the assessment, does not ask for percentage of owners to renters, and a few other questions that aren't asked as well. Simplifies the process. So what we do then is we get that 75% LTV first mortgage, which is the one you see here, very good rates. And then we combine that with the HELOC that you see down here at 11%. And then we get our combined loan to do our purchase with 10% down, as opposed to what would have been 25% down to be able to do this as a limited review. Limited review is available at 75% LTV on the first for primary and second home, and 70% LTV for investment properties. So is available for investment properties. You just have to make sure now, mind you, if you do employ this combo HELOC, now I'm talking about limited review, not limited review with the combo HELOC. So if you are going to do the combo loan, you just have to make sure that that program accepts investment properties for the HELOC. That would be the only catch there to make sure. But the 70% limited review, 70% LTV limited review option is definitely available for your investment properties. So for those of you trying to finance those Florida condo deals, which there are quite a few and amazing properties as well, this is your best option to come in with 10% down payment. And I guess I sort of forgot to mention, because it's, second nature here, but no mortgage insurance in any of these examples again. So that's like the frosting on the cake there. Not only are you able to do this with 10% down payment, but no mortgage insurance, where you could be saving easily on a loan amount of this size. You could easily be saving $300-400 a month. So that's a substantial amount. When you come down here and you look at the payment on this is $1,272, you almost have half of your payment paid for with the MI savings. So it's almost like free money that they're getting there to pay part of that HELOC, and combine that with an accelerated repayment, and in no time, your borrower is going to see the benefits of this setup. So really looking forward to helping everyone out there structure their combo loans. There's a lot of outside the box ways that we can do this and offer solutions where others see problems.
Perfect. Thank you, Jose. That was great. So as Jose said, lots of ways to combine a HELOC, a home equity line of credit, onto different loans for different reasons. So definitely something that you want to consult your loan officer about to walk you through these processes, right? So we have over 350 loan officers all around the country, licensed in 22 states, and a lot of investment properties we can do in other states as well. So go ahead and get with one of our loan officers. Maybe one of them shared this video with you. If you connect with them, they can send you a quote, just like Jose was showing you. They can send you a quote within minutes. Or if you're not working with one of our loan officers yet, feel free to go to themortgagecalculator.com and we will connect you with one of our loan officer consultants. And here at the Mortgage Calculator, our loan officers do not just do conventional FHA, VA, USDA, but they consult you through the process with not only the HELOC combo type situations that we're talking about, but also all of the thousands of non-QM programs that we have that Nick was mentioning earlier. So themortgagecalculator.com, we can connect you with one of our loan officers, or you can send us an email, info@themortgagecalculator.com. And we do this show every single weekday at 11 a.m. Eastern time and go through the live rates. It'll be interesting to see what it looks like on Monday as well. And then we do a deep dive into a different topic every day. So I hope everyone has a happy Friday, and we will see you on Monday at 11 a.m. Eastern. Have a great weekend, everyone.
Thanks, everybody.
Thank you, everybody.